Welcome to Lesson 1 of Module 2, Real Estate Investment Analysis. In this lesson, we will be discussing real estate valuation. Valuation is an important aspect of real estate investing, as it allows investors to determine the value of a property and make informed investment decisions. By the end of this lesson, you will have a solid understanding of the different methods of real estate valuation, how to calculate the value of a property using different valuation methods, and the strengths and weaknesses of each method. Real estate valuation methods. There are several methods of real estate valuation, each with its own strengths and weaknesses. The three most common methods of real estate valuation are the income approach, the sales comparison approach, and the cost approach. The income approach is used to value income-producing properties, such as rental properties. This method involves estimating the future income of the property and then discounting that income back to its present value. The income approach is particularly useful for valuing properties that generate consistent and predictable income streams. The sales comparison approach is used to value properties that are similar to recently sold properties in the same area. This method involves analyzing recent sales of similar properties and then adjusting for any differences between the subject property and the comparables. The sales comparison approach is particularly useful for valuing residential properties. The cost approach is used to value properties that are new or have recently undergone significant renovations. This method involves estimating the cost of building a similar property and then adjusting for any depreciation or obsolescence. The cost approach is particularly useful for valuing special-purpose properties, such as schools or hospitals. Analyzing real estate value. When analyzing real estate value, it's important to consider not only the value of the property itself, but also the potential income and expenses associated with the property. This can include rental income, property taxes, maintenance costs, and other expenses. By analyzing both the value of the property and its potential income and expenses, investors can make informed investment decisions and determine whether a property is a good investment opportunity. Real-world examples. To better understand the different methods of real estate valuation, let's look at some real-world examples. One example of using the income approach to value a property is for a rental property. By estimating the future rental income of the property and discounting that income back to its present value, investors can determine the current value of the property. Another example is using the sales comparison approach to value a residential property. By analyzing recent sales of similar properties in the same area and adjusting for any differences, investors can determine the value of the subject property. Activities. To further reinforce the concepts we've discussed, let's look at some activities you can do to practice real estate valuation. One activity is to analyze a real estate transaction using the income approach. By estimating the future rental income of the property and discounting that income back to its present value, you can determine the current value of the property. Another activity is to calculate the value of a property using the sales comparison approach. By analyzing recent sales of similar properties in the same area and adjusting for any differences, you can determine the value of the subject property. Discussion questions. To further your understanding of real estate valuation, let's discuss some important questions. What are the advantages and disadvantages of using the income approach to value a property? The income approach is particularly useful for valuing income-producing properties, but may not be suitable for valuing properties that generate inconsistent income streams. How can the sales comparison approach be used to identify potential investment opportunities? The sales comparison approach is particularly useful for identifying residential properties that are undervalued and may be good investment opportunities. In conclusion, real estate valuation is a critical component of real estate investing. By understanding the different methods of real estate valuation and how to calculate the value of a property using these methods, investors can make informed decisions about when and where to invest in real estate. The income approach and the sales comparison approach are two common methods of real estate valuation. The income approach is often used for income-producing properties and takes into account the income generated by the property. The sales comparison approach is more commonly used for residential properties and takes into account market trends and the condition of the property. Both methods have their advantages and disadvantages, but by analyzing the data and understanding the factors that affect property values, investors can identify potential investment opportunities and make informed decisions about real estate investing. We hope you found this lesson on real estate valuation informative and useful. In the next lesson, we will dive deeper into real estate investment analysis by discussing real estate investment returns. Thank you for watching, and we'll see you in the next lesson.